The proposed federal budget was just announced, and I want to go through some of the key aspects of that proposed budget that will affect you and your retirement. Now, within the budget itself, there's a lot of different changes, a lot of things and numbers that we need to look at. But in this video, I want to highlight the top 6 or 7 that will impact you going forward. The biggest change in the budget, and again, this is not approved yet, it still has to get approved, but the biggest change is the capital gains inclusion rate. And that means that on any capital gain that you receive going forward, post June 25th, possibly you're gonna pay more tax on. And I did a video on this over 2 years ago saying capital gains are going to change. The amount of tax you pay on capital gains will increase over time. I figured it might be 75%. Fortunately, it's only 66 and 2/3%. But again, there's that increase. So the warning was there, it's kind of the low-hanging fruit. Now, the way this was rolled out was really bad. Do I agree with the increase? No, of course not. I have to pay more tax, you have to pay more tax. The problem with the rollout is that they said it does not affect 99.87% of people, of Canadians. That's absolutely incorrect. It affects a lot of you in many different ways. So the budget proposes increasing the current capital gains inclusion rate for corporations and trusts from 50% to 66 and 2/3%. It also proposes similar increases for individuals, that's probably you, on the portion of capital gains that exceed $250,000 in a given year. These inclusion rate changes apply to dispositions on or after June 25th of 2024. So if you're an individual, you're not a company or trust, you're an individual, the first $250,000 of capital gains per year is still taxed at the old rate, 50%. It's only the amounts above the $250,000 that you're going to have the higher 66 and 2/3. If you're a company or a trust with maybe investments, you're going to start paying more tax on your capital gains. Now, this change, it affects a lot of us. Now, does that mean you go out and do a drastic change on your end? Probably not. Again, run the numbers, work with your financial planner and tax accountant to figure out, do you need to take action before that June 25th deadline? I'm not saying you do, I'm not saying you don't. What I'm saying is there's a change coming and you need to run your numbers with your tax professional. Now, when Trudeau came out and said it affects 0.13% of the Canadian population, I think he forgot how this exactly worked, because a lot of you will own cottages, second home, investment properties, and your investment accounts that may have a capital gain on it. There's other underlying factors as well that could be taxed. So it's going to affect a lot of you. You may have a family cottage that you paid $100,000 for back in the day, and you're planning to pass that on. It's worth $1 million now, but again, that capital gain is going to cripple the passing of that. So there's a lot of these factors that you guys are bumping up to. A lot of you have issues that you need to now face tax-wise around the capital gains inclusion rate. The amount of money that the government has printed over the last 3, 4, 5 years is alarming. And at the end of the day, they have to raise taxes. So they look for the low-hanging fruit. In my opinion, and that's why I did that video 2.5 years ago, the low-hanging fruit is capital gains. Typically, people that are triggering capital gains have second properties, larger non-registered investment accounts. It kind of is a low-hanging fruit. I hate to say it. I'm part of that. I have a corporate investment account. I am being taxed higher going forward after June 25th. I'm affected. Many of you are affected. Now, will this eventually go up? Could it come back down? It still needs approval. There's a lot of movement here. And this is the problem I always have with tax planning, retirement plan. You have to use kind of the compound of what you're in, the rules, the tax rules of what we're working within. But you have to look forward to say, well, where are things going? A lot of business owners, for instance, always said, no, Adam, I want to pay myself a dividend. I'm not doing RSPs. I'm just going to shove everything in my holding company to invest. And that's a great strategy, but I've always said, no, pay yourself a bit of a salary, build up the CPP. In case your business goes sideways, you have that CPP for retirement, which is a great buffer and tool and an income source in retirement. But also pay yourself a salary to build up an RSP, pull money out of your company to build up your RSP. Now with these tax changes, that is more beneficial to do too. So again, it used to be a bit of a wash. Now it pushes toward the RSP and looking to maximize that every year for business owners. So again, things change. Business side, personal side, tax changes will keep happening. So work within the compound we're in, but also try to plan ahead as best you can. And this is where we're working with your financial planner, with your tax accountant. No one knows the future, but a bit of common sense, and you can probably make some small tweaks to put yourself in a better position going forward. If you're concerned about the capital gain inclusion, which I am, you should be, it's probably going to affect you. There's a lot of videos out there. There's one great video done by Ben Felix, who's here on YouTube. We'll link that video below. He's done a great video on this. He does some great content on Twitter as well. And his firm that he works at, PWL Capital, has also put together a calculator to help you walk through this process. It's a personal calculator, so if you're looking at the corporate side, doesn't do it quite yet. But if you're looking at the personal, like should I sell, what's a break-even point, how much more tax am I going to pay, they've put together a great calculator, so we'll link that below as well. Again, we want to give you the tools to make the right decision. Again, take that, have a general idea, bring that to your financial planner, to your tax accountant, work out these numbers before the deadline. Again, if you have rental properties, this kind of stuff, it's going to be really hard to dispose of those properties in time, especially if you have renters in there now. I was talking to my realtor the other day, a good friend of mine. He said the deadline that they set has really capped people. Even if you have a rental property, by the time you give notice, sell it, hard to close it by that June 25th. So again, if you're thinking you might move that way, talk to your realtor, talk to your accountant, get things on track ASAP. The capital gain inclusion rate was the main part of the budget that will affect most of you, but I do want to cover a few other things that are important to a lot of you watching this video and changes that may affect you. So let's jump into them. The lifetime capital gains exemption. So the budget proposes to increase the lifetime capital gains exemption to $1.25 million. Previously, it was just over $1 million on eligible capital gains. This measure would apply to dispositions on or after the June 25th, 2024. The indexing on the lifetime capital gain exemption will commence again in 2026. So they're kind of giving a boost a little bit earlier than January 2025, but then extending it all the way into 2026 before it will jump up again. For any business owners here in Canada, the Canadian Entrepreneurial Incentive is, again, proposed in the budget, introducing an incentive to reduce the tax rate on capital gains on an eligible individual's disposition of qualifying shares. This means if you have a small business in Canada and sell it, there's an incentive to it. This incentive would provide for a capital gain inclusion rate of 50% of the prevailing inclusion rate. The lifetime limit would be phased in by increments of $200,000 per year beginning in January 2025 until it reaches $2 million by January 1st, 2023. Under the 66 2/3 capital gain inclusion rate proposed in the budget, this means the measure would result in an inclusion rate of 33% for qualifying disposition. The measure would apply to addition to any available lifetime capital gain. So in summary, what this means is if you sell a qualified small business and you could take advantage of this, again, it starts at $200,000, increases over time, that's on top of your lifetime capital gain exemption. So more incentive to sell your business, get more money tax-free. The big catch with this is that there's a lot of exclusion. Surprise, surprise. Personal services, financial planning. Like if I sell my business, this doesn't qualify. And there's a lot of you that have small businesses that would not qualify for this. So as great as this sounds, and it will affect some of you in a great way, I think for the majority of business owners, you're kind of in that exclusion list. So let's hope when it gets approved and it does go through, that exclusion list is taken off or at least eliminated a lot, because it's really saying, hey, here's this really good, effective tool to help you sell your business, transition, get into retirement. You've taken the risk as a business owner. We want to reward you, but everyone's excluded. So hopefully they limit that list a little bit going forward. The next change is with regards to the home buyers plan. So for anyone looking to buy a home, the budget proposes to increase the withdrawal limit from the current number of $35,000 to $60,000 for 2024 and subsequent years for withdrawals made after April 16, 2024, which is already passed. So perfect. So now you can actually take out up to $60,000 versus $35,000 out of your RSP for the first time home buyer plan. So for anyone looking to buy, or maybe you're watching this video and your kids looking to buy, make sure they do that. Now, one caveat and one thing you have to be really careful of is to draw money out of your RSP for a home buyer plan. First, you have to qualify as a first-time home buyer. But secondly, and a lot of people miss this, the money needs to be in the RRSP for at least 90 days. So you can't shove it in there and then take it out right away. It needs to sit in there for 90 days. So now that you know that this limit's gone up, you might want to consider topping up your RSP fairly quickly if you're planning to buy here in the next little bit. Just make sure that money, that RSP money, has been sitting in there for 90 days and you can document that. The proposed budget also looks to expand CPP benefits. So this is a great thing and something that actually has been talked about a lot on this channel in the comments. So a $5,000 death benefit will be payable to contributors who have no survivors and have never collected CPP payments. So again, a lot of you single people, there's a lot of single people that enter retirement, but there's also a lot of single people that pass away and there's no death benefit. And that's, a loss to them. And again, I know $5,000 isn't a lot of money, but hey, something's better than nothing. So this compares to the standard $2,500 death benefit of all eligible contributors will continue to receive. The CPP death benefit is such a small amount in retrospect for how much you pay in. It just is what it is. But at least there's something there now. They're thinking about everyone. The government will also introduce a partial survivor child benefit for part-time students under 25 and attending a recognized post-secondary institution. So the CPP surviving child benefit is currently payable to 18 or under age 25 and attending post-secondary school full-time. And one of the other changes with regards to CPP survivor benefit is currently couples who are legally separated but still legally married or in a common law relationship may be eligible for survivor pension when their partner dies. But a CPP amendment will end eligibility for survivor pensions as soon as the couple is legally separated. So small change there that may affect you. And we've had that question, actually had it quite a few times in the comments, asking how this works. So there's how it works and there's the changes going forward. One of the other proposed changes is regards to RESP. And I know a lot of you watching this video might say, Adam, RESPs is so long ago, I don't even think about that anymore. But you may have kids, grandkids, family, friends, someone that can take advantage of this. And this is something that I've thought should be automatic. And so RESPs will have an auto enroll. So if a child doesn't have an RESP by the age of 4, the government will automatically open one for them and enroll them in the Canadian or Canada Learning Bond, the CLB. This will begin in 2028 to 2029 fiscal year for children born in 2024. So again, a lot of parents don't set up an RESP, they forget about it, they don't know it's there, and there's a lot of free grant and free money to be had. In fact, contributions up to $2,500 a year get a 20% grant. That's free money. That's a great investment return. And so RESPs need to be taken advantage of, and a lot of you aren't. I had a client yesterday email me and say, Adam, I'm looking to set up a RESP for my first grandchild. How do I do it? So again, this is great. I love getting those emails because that is helping your grandkids, creating generational wealth. They're going to really appreciate that down the road. So again, you may not be setting up for them, but if you have kids, grandkids, great-grandkids maybe even, make sure they're aware of RESPs. But again, this auto-enroll will make sure that all kids going forward, born in 2024 and beyond, will be able to take advantage of a lot of the free money, free grants and bonds. The last change I want to talk about here today, and again, there's a lot of changes happening. To me, the capital gain inclusion rate is by far the biggest. That's the biggest one that will affect a lot of you, but this one will actually affect a lot of you as well, and you need to know about it, and it's the automatic tax filing. So about 17% of Canadians that earn under $20,000 a year do not file their taxes, which means that you're missing out on a lot of benefits that you would be eligible for. Again, you have to file your taxes to get the government benefits that are out there. With this automatic tax filing, it's going to allow a lot of the lower income earners to get their tax filings done to be eligible for a lot of the tax benefits, credits that are out there. So again, this is a great thing. They should have done this a long time ago. The US has done it for a few years now. So it's great to see that roll up into Canada. I hope this does get approved and go through. All the details are still to be announced as far as eligibility and what income level and all that. But this will help a lot of the lower income earners get that tax filing done and get the benefits and credits that they deserve. So thanks for joining us in this video. If you're affected by any of the tax changes, leave a comment below. I tried to keep it not too political, but there are a lot of changes coming. And especially for that capital gains inclusion rate, if you're running into an experience that you want to share, again, leave it below. We have a great community here. I love watching everyone comment on each other, support each other in this community. That's why we did it. So make sure you comment below, get everyone involved, and we'll see you in the next video.